Welcome to this seminar. Obviously, it's set that your cameras and mics are off, so you can just view without any issues. So welcome today. My name's Russ Bocock. We also have here Dwayne Anderson, Reese Keys, and Joel Robertson presenting to you. So if you have any questions or anything, you can type them through. But yeah, we look forward to this. This is being recorded, so we will send this out to you afterwards. If you want to refer back to it. So what will we be talking about today? So the agenda today will be the topics of mastering your equity in your property, bank versus broker, mortgage myths, debt reduction, talking about wealth accumulation and personal protection. So myself and Reese, we are qualified financial advisors, and Joel and Dwayne, they are both qualified mortgage brokers, and we're from Sternlight and they're from Mega Capital there. So I will start the topic off talking around utilising your equity within your property there. So who we are as a company, we've got Google reviews. You can go onto our website so you can see our Google reviews there. But we'll get into it. So what am I here to talk about? So how we can save you thousands of dollars in tax, pay off your home loan sooner, build your wealth, and then eventually Reese will talk into protecting your family overall there. All right, so what strategy I'm talking about here is a strategy called debt recycling. So how this works is you utilize the equity within your home and you draw those funds out to invest. So your home loan is what we call bad debt. Bad debt is non-tax deductible debt. So similar to like car loans, buy now, pay later loans, they're all bad debt because they do not generate wealth for you. And what you can do is when you've got available equity, most people look at it and they go, cool, I want to purchase a property. But you can use this as well to purchase other areas like property shares, and you redraw that. Now, what makes this tax deductible is the ATO ruling. If you borrow money to buy shares or related investments from which you earn dividends or other assessable income, you can claim a tax deduction for the interest you pay. So we do have a case study for this. So let me just explain how this works. So you have the equity and then you borrow that money out. You invest that into an asset that is producing dividends. From there, you then utilize those dividends to pay back onto your home loan, which is bad debt, and then each year you're able to claim that equity as a tax deduction. Again, using those tax deductions to pay off your home loan, and then you repeat that cycle. And the idea of that is starting off small and then growing over time. And you'll see that with this case study here. So if you look at year one, you got the home loan, purchase 100,000 in shares. You have growth from that share as well as dividends. The dividends get paid off your home loan and your shares continue to grow. Now, let's say right now that investment loan is sitting at around a 6% interest rate. That is tax deductible, making it an effective tax loan of around 4% after tax. Now, if we look at the long-term returns since 1970, US shares, Australian shares, international shares, you're sitting at 9, 10, 12% returns per annum. So any dollar figure, any percentage return above that 6% is putting you in a positive position overall. Now, there is some risks involved in this, and we will go through that shortly. So here's a case study. So this was a married couple. They have one kid and they are expecting to have a second in the future, but not currently. Aged 29 and 30. One of them is a teacher earning around 102,000, and the other is a retail worker earning around 65,000. So what you see there is it's not just designed for ultra high net worth or anything. These are everyday families, everyday people. Living expenses are around 72,000. So it's a very average family, couple, one kid. Now, we've been working on this strategy for about 3 to 4 years with them now, and currently they're on track to have their home loan paid off by the age of 35 and 36. their investment portfolio is estimated to grow to about 194,000. But the biggest thing is having their home paid off by that, saving them about $122,000 in interest over that period. So not only are their investment portfolio worth 194, they've now got no debt by the time they're 35 years old. Now that is hard to believe, especially in this day and age now. And actually, in recent conversations with them, they're actually now looking at the potential of an investment property moving forward, or actually turning their existing home into an investment and moving into a bigger home for themselves. So, as you can see, it's not massive earnings in terms of a family income, but it's about making that money utilized smart and making it grow for you. So that's the key thing. Now, who is eligible for this? So to be eligible, you need a home with some equity available, or at least looking to purchase your first home. You need a regular income from your employer or your business if you're self-employed, and you have to have a long-term focus. We're not talking about get rich quick schemes here. It's a long process. That couple that I've spoken to about before, we're talking 10 years to get their home loan completely paid off with an investment property. Now that is far better than the 30 years that the banks will give you, but they're also growing in wealth. So some of the benefits from here, you're talking tax advantages, interest saved, wealth accumulation, paying off your home loan faster, diversification, and this works with shares or investment property. You can go either way. Now, as I said, there are risks involved. So you've got investment risk, you've got interest rate risk. What happens if the interest rates continue going up? You have to be able to have that good cash flow to cover that in that period of time. And one of the most important parts of this is actually your behavior. So your behavior is very important. You've got good budgeting skills. You're paying off dividends off your home loan, you're using your tax deductions to pay them off. If you are then drawing that money out to purchase cars or spend on smaller things on a day-to-day basis, then you're not going to see those benefits of getting your home loan paid off soon. So it's important to have those good budgeting skills within there that we can help with overall. So if that's something that looks enticing for you, we can help and have more of a discussion with you regarding this. From here, what I'll do now is I'll pass you over to Joel. So Joel is a mortgage broker with Omega Capital. So I will just stop sharing my screen and I'll let Joel share his screen for his portion here.
No worries, thank you. Good afternoon, everybody, and thank you very much for joining us today. So on the mortgage broking side of this presentation, myself, I'm Joel Robertson. I'm here with Dwayne Anderson, and we're both the co-founders of Omega Capital. We have a combined 10 years experience in the financial industry. We're super passionate about helping people achieve financial goals through providing that mortgage advice. I myself have a qualification in financial planning, so it does make it easy to understand the lingo when we tie in with the other professional partners as you transition through life's journey as well. So I really want to take this opportunity to highlight what really strikes us out as mortgage brokers. And look, our philosophy essentially is seeking to understand our client goals, property or otherwise, and reverse engineer the finance to meet their clients' objectives. So after all, finance is going to be the biggest tool and the key to acquiring property and other larger financial goals. So it's really important to have the right people on your side throughout the journey. So it's likely that you will have a big home loan from potentially from your 20s, right through to your 60s even, assuming you don't undergo some debt recycling strategy like Ross has pointed out. But it's really important that you have a team that remains flexible and pivot as your circumstances are going to change over this really long period. So typically, if you pick up the phone and have a chat with a bank or a broker, they might let you know where your buying power is right now and perhaps send you away. But where we really pride ourselves is going the extra mile to understand more about your goals and what asset you want to get yourself into, for example. And if you can't quite meet that, we'll reverse engineer the process and see what would need to change for you to be able to meet that asset requirement. And that might be advising on, where your income would need to be, where, your savings position would need to be, maybe kids need to move out, maybe we need living expenses to be reduced, Maybe we need to bring a guarantor to the party. So they're the types of things that we're talking about when we say reverse engineer the finance to meet the goal, not the other way around. So a little bit about what I'll talk about today, a bank versus broker, a bit about how borrowing power works. But the big ones are going to be the scenarios such as your family guarantee. So if you have a family member that has nearly paid off their home loan, it's going to be very important for you to understand that and how that works. And a bit about the differences between the banks when it comes to borrowing power. Okay. Now just have a chat about bank versus broker and understanding the key differences. So brokers have access to 30 plus or minus lenders on our panel. These are your everyday lenders from your big four to your online, etc. They're lenders that, as an individual, you can pick up the phone and have a chat to yourself. So that's why I think it's really important to highlight as to why you wouldn't do that and why you want to go with a professional that has access to the lender anyway. So the big one is if you pick up the phone and chat to just your bank, you're very much siloed into the options that that bank can offer you as far as rate and what's possible. And I'll give you the guarantor example where we save somebody nearly $70,000 just from not going with their existing bank and how we helped out. The other one is that we create lifelong relationships. So we really do thrive on seeing people at the start of their property journey right through to the end and watch all those goals really come to fruition. Whereas with a bank, and I've been a banker before, done home loans in the bank, we had to see 6 clients a day and take 3 applications. And look, there was just no hope of really having an intimate relationship with clients and really understanding what they want. You just couldn't do it. It was just nearly impossible with that volume. So, consulting a broker is very different to that, very different indeed. Not to mention that we're actually legally obliged to act in your best interest by way of providing comparisons and making sure that it meets your needs, objectives, and requirements. Now, tailored solutions, as you move throughout your financial journey, sounds a little bit cliche when you say your specific circumstances, but I'm going to rattle off a few that may be a little bit, or that will be likely relevant to yourself, either one or maybe even a few that classifies as unique circumstances. For example, have you had a recent job change, or do you anticipate job changes, perhaps a promotion, for example? Are you thinking of starting a family? Do you have a small family or have dependents leaving the household or moving through schooling? Are you thinking of starting a business? Are you thinking of having a side business? Or have you not been in business long and think that you might not qualify for a loan? Are you wanting to perhaps invest with siblings, maybe to help a parent out? Or are you going to upsize your home or downsize your home or do an extensive renovation? Or maybe you've thought about buying property in a self-managed super fund. So these are all very real circumstances. And there is no single lender on panel that can accommodate multiple of those for the best that the market has to offer. So it's really important to be engaging with somebody who has visibility and oversight over all the different lenders. We look at the goal and again reverse engineer the finance to the goal. Okay. So, and that's really where we step in and provide you those comparisons and move you a little bit step closer to what you're trying to achieve. So let's look at the client scenario here. This is the family guarantor. So if you have a family member that has the house nearly paid off or paid off, it's particularly relevant to you. We have an existing client, Sarah, used all her money to buy an owner-occupied property, but really wanted to buy an investment. A guarantor was on the cards, but the parent wasn't gainfully employed, wasn't working. So she picked up the phone, spoke to the bank. The guarantor had to be working, so couldn't make it happen unless you were charged $67,000 in lender's mortgage insurance, which is exuberant. So, and look, she was told this is the only way to make this happen. Okay, lucky enough, Sarah came to us. We had a multitude of good outcomes for Sarah. Not only did she not pay the $67,000 lender's mortgage insurance, the guarantor got a better rate on their home loan when we brought them over to the new lender. And she didn't put a dime down on the property. She said full lend plus costs. Okay, we quite literally trawled through all 30 lenders and see who would undertake the guarantor without the guarantor working and found them a suitable lender. And it was really as simple as that. And that phone call saved her nearly $70,000. So it's a very happy client indeed. Now, I want to have a chat about borrowing power because it's important to understand how to calculate borrowing power and use it really effectively. Because there's two parts to it. One's your income and one's your equity. And it's important not to confuse the two. So income refers to your job, PAYG, overtime, all that sort of stuff, income from rental properties, maybe company profits if you're self-employed. So that determines your ability to afford the loan. The equity, on the other hand, that is your cash and the value you've brought up that's accumulated inside the property. Okay, so many people confuse the two, and you can't have just one or the other, or it seriously hinders your borrowing power. For example, if you've paid off your home but you don't have, a high income job, you're probably going to have, it's not going to be, your borrowing power is not going to be as big as what you think it is because that's sort of holding you back. You've got to have a nice balance of the two of them. And I'll give you an example here. So let's have a look in this example. This is a single applicant. He wants to buy an owner-occupied place, $150,000. He owns, works in the mines, spends all his money, so he's only got 5% plus costs. And let's look at the comparisons, and we'll compare the extremities here, for example. Westpac, his maximum borrowing is $634,894. It calculates it to the dollar. And whereas NAB is $564,000. So it's talking a $70,000 borrowing power difference, which really matters on this end of the market. And then if we draw attention over the rate as well, so we're talking 6.51 for Westpac versus NAB's 7.92. Now, NAB is a bit of an old-fashioned big bank as well. A lot of people have long existing accounts. Mum and dad had the account for 15 years and that sort of thing. If you were to pick up the phone and just go with them, you would be entirely governed by exactly what they have to offer. Now, the really important thing to understand with this is Westpac with this rate was not offering this rate a month ago and then probably not going to offer it in another month or two. So what this tells me about the rate that they're offering is they don't have many loans in their back book at 95% owner-occupier. So they've dropped the pricing, they'll fill their book up, and then they'll jack the pricing back up for new loans. So this is where you've got to, it might be NAB that's doing this next month, and it might be CBA the month after. So it's really important to engage with somebody that has oversight of these lenders. We can cash it in at the right rate and secure that one for you. Okay. And if we go down to the second example, look here, it's a couple with two kids. They want to buy an investment property, but a 90% lend. Okay. Now, if we go back to the extremities, you look at ANZ, for example, 950 with 681 versus Newcastle in the 7724. Now, again, that's a massive difference. We're talking 180 grand borrowing power. And look, Newcastle Permanent is an online lender. They're somebody that you would expect have extremely good rates, and it's just not the space that they operate in, and the results are very clear indeed. So, but look, if you only wanted to buy at 700, then we'd probably just go with the cheapest lender because that's all we need. We don't need to tap in the buying power. So it's really good to have somebody to do those comparisons for you. And look, this is the final client scenario. We had a client come to us. She didn't know whether to buy investment property or rent out her current place and buy an owner-occupier. And there's two very big disparities between the two. So, for example, if she decides to rent out her home and buy a new property and move into it, her buying power is 920 versus if she did it the other way around is 1.2. And that's about where she wanted to buy. So she was told that you couldn't make it happen by the way she was thinking. So we offered, did you want to put a tenant in there? And we can look at making it happen. So just quickly, I want to go for my final point is look at ING. If you didn't think to reverse engineer and buy an investment property as opposed to moving into it, and a lot of people do their daily bank with ING, they're a good bank, good rates and that sort of thing. If you picked up the phone, they would tell you your buying power is $62,000. You essentially fall off your chair and you wouldn't even bother calling any other lenders just thinking there's no way you can make it happen. In this case, who would have thought Bankwest came to the party with 1.2 versus, ING's 360. So had a very happy customer indeed and got the application over the line. They secured that property. So guys, thank you very much for listening. More than happy to have a free conversation and have a look at some objectives that people have and really reverse engineer how we can use the finance to make it happen. The best time to contact a broker is straight away to really set up those goals as you move forward. Please don't make any assumptions about what you think the bank wants and wait 2 years, whatever it may be. Contact us now and we'll have a chat. And if that means waiting that period, then that's fine with us. But thank you very much for listening, and back over to you, Ross and Reese.
So I just want to take a few minutes. Whenever you're taking on more debt or you're trying to protect your debt, it's always important to talk about personal protection insurance. So these are the insurances that basically look after yourself and your family if something was to happen. So the 5 main ones are life, TPD or total permanent disability, income protection, trauma, and business insurance to some extent. So they are they're simple, they're suitable, and they're transparent. But it's important to make sure that you use, much with mortgage broking, it's important to make that you use the right provider to make sure it's the most cost effective and gives you the benefits that you need. When we see a lot of clients come to us, they go, we've just got insurance through our superannuation, which is great. They've got some level of protection, but they don't actually know how much insurance they have. And they're usually not really aware of what it's costing. But what we've got is a little bit of a case study here. As you can see, this person came and they had $230,000 life and TPD. That's all they had through their superannuation. And it was costing $589 a year, which seems pretty cheap. But when you compared it to what insurance they could get, you could actually get just over 4 times the amount of insurance for $34 or $37 cheaper than they were currently paying. But why was it so much cheaper? As a group policy, it just protects everybody. So it doesn't ask you any health questions to make sure that you're suitable for them. It just gives you a blanket level of cover, and it doesn't discriminate between jobs that are risky or not risky. Whereas if you go for a personalised option, it's personalised to your needs. We also do a full needs analysis to make sure you've got the right amounts of insurance, and we also compare other insurance providers to make sure that we've got the best in class for you. So if there's any questions about this insurance at all, please feel free to reach out. Ross and myself are more than happy to help out. Otherwise, I will...
Yep. So outside of that, we are holistic advisors. So we do look after superannuation, investments, debt management, property, retirement. But yeah, mainly we wanted to talk about those 2 points today. And then from here, we will pass you back over to Dwayne to run through a little bit more about the mortgage broking world there.
So my name is Dwayne Anderson, working with Joel Robertson at Omega Capital. And as we mentioned, we are mortgage brokers. So one of our big objectives is to help our clients through their financial strategies to get into new property, refinance, or to invest. First of all, I'd just like to say thank you to Ross and Reese for putting this on and having us come in and present. I've really enjoyed just some of the points that you've gone through, particularly the debt recycling and the wealth generation and personal protection stuff. So some of the things that I'll be going through, I'll try and make it nice and quick for you all and keep it as interesting as possible. But I'll be looking at debt consolidation, mastering your equity, and trying to combine or tie it all together. So how we can look at your financial strategies to improve cash flow, save an interest over the long term, and progress to invest. So I don't know how many of you here have multiple debts, but with debt consolidation, the ultimate aim and goal is to simplify your finances and to improve your cash flow. I've had clients that have come to me with literally 10 credit cards. They obviously had fantastic income. They could afford all the credit cards, but they were sinking in repayments. They couldn't do anything. So one of the first things that we have to look at doing is consolidating all of their debts, paying off their credit cards, and moving it all into the one loan on the lower interest rate. So they had massively improved cash flow and more financial flexibility, which feeds into the, if they were doing additional repayments on their mortgage, paying their mortgage off faster, or into an investment strategy. Additionally, with the reduced cash flow, it allowed them to be able to borrow more, which is really important when it comes to your debt consolidation and your debt recycling strategies. This graph on the left here is looking at a pretty typical situation. The average mortgage size in Australia is or in Queensland is around $600,000 at the moment. Last year it was around 520,000, so it's gone up roughly about 15%. And I've based this on consolidating a debt of a car that's around $35,000 to $40,000, which the monthly repayments on that were $700 a month. Once they made the savings of consolidating that car loan and put the additional repayments into the mortgage, it allowed them to pay off the mortgage faster. So as the graph shows, they saved roughly 10 years in their mortgage. But if you look at the top here, the total saving in interest for that scenario would be $276,000, which is impressive. This is a real life client scenario. I'm using pseudonyms here, so I'm not putting the actual client names up for you all to see. But Luke and Michelle, they are hard workers, both with decent incomes. They've got a few children, and they're looking at improving their financial strategy so that they can look at things like debt recycling. So they came to me, they had a mortgage or a debt of $258,000 at a very average interest rate price or interest rate of 6.55. They were paying around $1,645,000 a month, and that was going to be over the next 26 years. They also had a vehicle loan of $32,000, which was monthly repayments of $792. That was a loan that was taken out in the same bank. So they were pretty much hamstrung on being able to borrow more money with them to activate any further investments or borrowing for things like their debt recycling. So they did come to me. I consolidated the debts with a new lender. I got them a far better rate, 6.22%. And the new debt was $293,000. Their monthly repayments were reduced to $1,799 total. Their combined repayments previously were $2,442. So with that difference in savings, which was $643 per month, if they just simply put that into their mortgage as additional repayments, they'll pay their mortgage off in half the time, 15.7 years, and they'll be saving $187,000 or $188,000 in interest, which is significant. If you combine this with your debt recycling strategies, then you'll probably you will pay off the loan even faster and be left with a nice little nest egg of shares at the end. So one of the most important things when looking at whether you're going to be doing future investment strategies or you're looking to get cash out is understanding equity. I know we all have a pretty good idea of what that might look like, but ultimately what we want to do is avoid lender's mortgage insurance. Once we get into lending over 80%, we start becoming liable for lender's mortgage insurance, which can be a fair bit of a slog. So in this example here, so total home value of $500,000, these clients or these people, prospective people, they've only got 30% owing on their property with $150,000. That gives them a gap between that 30% of what the home value is on what they're owing up to the 80%. So they can borrow an extra $250,000 on that property, which could be used for different cash out reasons. Those cash out reasons could be for weddings, if they wanted to put money into things like car loans, which we may not recommend based on our financial strategies, but ultimately to put that money towards another investment, whether it's a property or whether it's part of their financial strategy into something like debt recycling or other investments. It's really important to know the with the way that banks value property. So if I can get one client come to me wanting to do this cash out example, let's keep it at 500,000. This initial bank might have said that they can only borrow 500, that their home property might be worth 500,000 based on their valuation metrics. I can go to another lender, do another valuation, and that bank may come back with a new home value of $600,000 based on their updated data or the way that they do things. So that will naturally increase the amount of cash out that they can do. And I've got examples around that later. So one of the things that clients do discuss or want to discuss with me regularly is cross-collateralization versus cash out to purchase. Basically, the cross-collateralization is, if you look at the diagram on the left, you've got two properties. They've got an initial owner-occupied property valued at $1 million, and they basically join they want to purchase another property for 500,000 as an investment. They join the property values together. So if you see the total security value of 1.5 mil, that would allow them to borrow a total loan of 1.2 million, staying under that 80% loan to value. Conversely, another way that we could do it is as a split loan setup. So that's where we look at cashing out against that $1 million property. So let's say the property's worth 700, oh, sorry, the debt that they've got 700,000, they can take $100,000 and cash out. That's money that they can use towards purchasing another property. In this setup, we can keep it with the same bank as split loans, or we can go to another lender. Reasons why we might stay with the same bank or go to another lender: different banks use different interest rates for different owner-occupieds and investments. So that's all down to us looking at the different options available to you and directing you in the right place. So additionally, some people might prefer to keep things as simple as possible, and they prefer to keep things cross-collateralized. The risks on the cross-collateralization that people feel is if you're not paying off one mortgage, the bank actually has access to be able to sell both properties, which it's a bit of a misconception that they would do that. They will work with you to make sure that you're not left high and dry. So if you needed to sell one property, they would work with you to sell one property. So in the end, it often works out to be quite much the same as far as a risk perspective, but they are able to sell both properties if they need to. So going on from how to cross-collateralization or looking at cash out, when we're looking at investing in property, having a firm understanding of what your finances are doing is the game. And for us as mortgage brokers, houses are the central prize. So, you know, obviously we can look at different strategies as we've discussed through this presentation. With investments, we do want to look at investment grade. So looking at capital growth and rental income. And if we look at this graph on the right here, similar to what Joel was talking about between different banks, this graph here is based on interest only. And as you can see, there's a pretty big spread between the different lenders. So depending on the outcome that we want to achieve for the client, if the client were to go to the bank directly, they might, if they went to Bank Australia, they might be out of pocket or not being able to borrow their full capacity as if they were to go to First Mac. And this is a continuous sliding scale. Additionally, just a quick note on the interest only. Your borrowing capacity on interest only is generally lower than if you're looking at principal and interest. So the calculations on principal and interest is over 30 years, where banks assess repayments for interest only over a 25-year period, assuming it's a 5-year interest only. So there's a few things there to take into consideration. Finally, I'll try and make this as quick as possible. I know that you're all on your lunch break. So I had a client come to me. They actually had debt that needed to be consolidated. They were told initially that they were going to struggle to borrow more money to purchase an investment. I consolidated their debt, their vehicle loan, into a new owner-occupied mortgage with a new lender. Additionally, I wanted to maximize how much they could take out based on that 80% loan to value. The initial lender valued their property at 760,000, only allowing them to get cash out of 158. The new valuation of the new lender came back as 896,000. It allowed them to borrow $266,000 at a much better rate of 6.19. What this allowed them to do is get a better rate, get the cash out, and use that 266,800 to contribute to another investment property. We went to another lender for the investment property based on the way that that lender calculated interest rates, and we got them a fantastic rate. What they actually ended up doing is they preferred the new property, so they moved out of the initial property and moved into the new one, and it's closer to the city and closer to their work. So that was very much across a back engineering strategy, and it was a great outcome for them. So I just wanted to finish off by saying thank you all for listening to me. I hope you've enjoyed this presentation, and I'll pass you back over to Ross and Reese just to wrap up.
Yeah, guys. So thank you for that, Dwayne. That was very informative, and We appreciate everyone's time today. So after this, we will be reaching out to you and we will have this as a recording, so we'll upload that. If you have any questions in the meantime, feel free to send us a message or give us a call. Our details were on the original invite, but yeah, feel free to reach out and we look forward to seeing you in the future. We'll be trying to host more of these webinars throughout the year as well. So all the best, guys. Have a good rest of the day and we will talk soon. Thank you.